Hello, this is John Eade, and I'm president of Argus Research Group. I'm here today to talk about some of the recent developments at Argus Research. We've been keeping a very close eye on US GDP, gross domestic product. The fourth quarter numbers have been updated by the US Commerce Department, and growth has settled at the end of 2020 at around 4%. And that's a big change from the 30% up and down swings we were seeing earlier in the year. That 4% is a good number, it's stable, and we actually think it's going to pick up in this first quarter of 2021. Some of the consumer spending data that we've seen has been very robust, and not just in e-commerce either. So we've recently increased our GDP forecasts for the first quarter here in the US to 5.8%. That's going to be higher than the 4% rate that we saw in the recently concluded fourth quarter. We do expect GDP growth to stay positive in the US in 2021. I know there are some countries that are fearing a double dip recession. We don't think that's going to occur in the US, although we do think that growth will slow down from that 5.8% rebound rate and probably average around 4% for the year, and then closer to 2.5% in 2022. And that's the growth rate that we were generally seeing prior to the pandemic. So as investors have become accustomed to these forecasts for better growth, we've seen long-term interest rates head higher. The 10-year benchmark treasury bond in the US yielded about 0.5% last summer. Now it's at about 1.5%. Meanwhile, the US Federal Reserve is keeping short-term interest rates very low, so we have a steep yield curve here in the US. And that yield curve reflects what I just said, expectations for stronger economic growth and maybe a touch of inflation along with that. As we expect these GDP numbers to come in at above average rates, we do think that the 10-year treasury yield will continue to drift higher into 2022, and from 1.5% may rise to 2% by the end of next year. So while that's a lot higher than 0.5% from last year, that's still very low on a historical basis. And those are two of our primary factors why we're bullish on stocks: recovering US economy and relatively low interest rates. Now, as these rates have backed up in recent weeks, we've seen this US stock market become more volatile, approaching a pullback, which we determine as a 5% decline in stocks from all-time highs. Typically, we get about 3 pullbacks a year, and something like a correction, 10%, we see maybe once every 18 months. So pullbacks are certainly normal, and given our forecast for excellent economic growth and low interest rates, we think those are going to be good opportunities to buy stocks. We like to focus on quality stocks, and a couple of the themes that we've been looking at include dividend growth. Companies, it doesn't matter what sector, that are growing their dividends at least 10% for 5 years in a row. There aren't many of them, maybe 50 or 75, but they tend to be well-managed, financially strong companies with a focus on shareholder returns. And we also are looking at companies that have high ESG scores. That's environmental, social, and governance scores. That means these companies are thinking not just about their businesses, but about their workers, about their customers, about the communities that they operate in, about the environment. And we've found that companies with high ESG scores tend to have very strong management teams. And we think it's those management teams that will lead companies to the other side of this pandemic crisis. So to wrap up, we're expecting strong US economic growth in 2021, interest rates to drift slightly higher, not too high though, still remaining low on a historical basis. We may see some pullbacks in stocks along the way. Those are going to be buying opportunities for themes such as dividend growth and ESG.